Welcome back to another episode of Quants Worth Following. Today, I have with me Alexander Reyfman, the co-founder and CEO of Tradewell Technologies. Welcome, Alex. I would appreciate if you could introduce yourself in your own words.
Yeah, thanks, Christina. Great to be here. So I've had a rather lengthy career on Wall Street, starting at Lehman Brothers many years ago. Initially, I worked in client research and strategy, but over time, I migrated to managing portfolios and trading. And then more recently, that has led me to become involved in the electronic trading of corporate credit instruments, such as CDS indices and corporate bonds. That started a little over 10 years ago when I was at Barclays, and then continued during my time at SquarePoint, which is a systematic hedge fund, and ultimately led me to start Tradewell Technologies.
Amazing. What are some of the key lessons and stories from your early career at Lehman, Goldman, and Bear Stearns?
Yeah, well, we can go on for hours. The industry has really changed, and the change occurred after the great financial crisis in terms of obvious things like culture, and a lot of those things changed for the better, but then other things like entrepreneurship and ability to build businesses quickly. I would say that before the crisis, even the largest banks were very entrepreneurial, where it was pretty easy to start new businesses, try things, fail, try again. These were flat organizations where decisions were made very quickly. Post-crisis, that started to change, and now we find ourselves where banks are pretty heavily regulated and have a lot less appetite to undertake large expansions, particularly if it involves technology. And for that reason, we're seeing emergence of competitors, and not surprisingly, firms like Jane Street, Citadel Securities, and so forth. And the reason we're seeing that is that these newcomers don't have the same regulatory burden, as well as are not weighed down by technological debt that's been accumulated over the many decades that the large banks have been in existence.
Was that one of the reasons why you decided to join AQR eventually? I'm just curious, like how you initially got into quant trading.
Yeah, I joined AQR before the crisis, and that was motivated by my desire to learn the portfolio management side of the business. And that was a great place to land. And I learned a ton from the folks over there in terms of how to think about risk, how to think about return, how to construct portfolios. So that was a great experience for me. And it led me to start trading credit. Back then, it was single name credit default swaps. So as funny as it sounds today, in the middle of that decade, the first decade of the century, single name CDS were in some sense more liquid than corporate bonds. So if you were running a systematic strategy that had views on corporate credit, implementing it with single name CDS was actually more efficient than with corporate bonds. Post crisis and the regulations that came after, that's no longer the case. But back then, CDS was the way to go.
Wow. What are some of the lessons you learned as a global head of algorithmic credit trading at Barclays?
Yeah, that was one of the most fascinating things I worked on because it involved participating in a very kind of key transition in market structure. So you might know that credit markets in general were very much voice and OTC driven. Post-crisis, the electronification of secondary trading really picked up. Now, in other markets like equities and, say, futures, electronic trading very quickly led to automated trading. But because of differences in market structure in credit, the switch to electronic trading led by many years the emergence of automated trading. So my initial role at Barclays was to work on the very first generation of market making algos. So prior to that point, although there was electronic trading, and when I say electronic trading, I mean essentially RFQ, or request for quote type trading, that was growing pretty rapidly in corporate bonds, but it was entirely manual. So the buy side would send RFQs, and then a trader or a dealer would type in a response. So that was obviously not sustainable. So the business at Barclays asked us to develop a system for automatically responding to these client RFQs to free up traders' time. That was the initial ask. Now, since then, these market making algos have evolved to be a really key part of the overall trading business. The way that large banks have organized themselves is about, say, roughly half of the balance sheet is dedicated to voice or manual trading, and half is dedicated to algo, ETFR, and portfolio trading, which typically occur in the same book. So what started out as kind of a time-saving device for traders has evolved into a very important risk and balance sheet management tool for the banks. So that was the first leg of these changes in the market. Naturally, the question is, okay, if the dealers have algos, why doesn't the buy side? And that's what I started to work on when I moved to SquarePoint. So their idea was, okay, just like at AQR, let's have a systematic long-short credit strategy. But this time, let's build a system for executing these trades passively. So we would trade US corporate bonds electronically, but we would not do it manually. We would build a system for engaging with this liquidity in an automated fashion, so an algorithmic fashion. And I think we're one of the first, if not the first, buy-side firm to have something like that up and running.
Wow. Curious about beyond the kind of electronification over the years and what that change must have meant for the industry. What are some of the other bigger changes you've seen? And also from the perspective of a job candidate, what are some of the different skill sets that people might be looking for today compared to when you joined?
Yeah, well, so I guess the first part of the question about what this means for the market, I think in this regard, our market is very similar to other markets. There's intense focus on efficiency, cost savings, doing more with less, automating as much as possible, and then also using data for decision making. I think the state of the art for portfolio and risk management in markets like equities is a little bit ahead of where we are in credit. And I think part of that reason is just lack of good data. So whereas in equities, we can get amazingly clean data from folks like Databento, in credit, that's not the case. So what people have to do is basically, instead of subscribing to a market data feed, they have to either build their own pricing model, which is a kind of real-time machine learning framework that sucks in all the available data, most of which is post-trade, and then comes up with a prediction for where a particular corporate bond might trade. Or they, instead of developing their own, they can try to license one from one of the several vendors out there who sell these models. But the lack of data has, I think, held back some of the developments in risk and portfolio management that you're probably used to if you're coming from equities from happening in credit at the same rate. I think we're catching up, but we're still definitely behind. So I think that's the answer to your first question. The second question about what skills are we looking for in the industry, I think the answer to the first question kind of suggests what those are, right? So this is ability to work with data, particularly time series or cross-sectional data, in a way that goes from this fire hose of asynchronous, rather large dimensional, sometimes poorly structured data into something that can be used by a front office person, either a trader or portfolio manager or risk manager. And the skills behind that are machine learning, statistics, whatever you want to call it, ability to develop robust real-time systems, either in Python or some other language like that, as well as understanding of market risk and just risk factors in general. So those are the kinds of things that we, others, like my counterparts, say on the dealer side when they hire quants. Those are the kinds of skills they look for.
Amazing. Thank you for answering that. After many decades in this industry, working for such large firms, some of the largest leaders in the industry, what inspired you to start your own company?
Yeah, so on one hand, there's a huge opportunity because the market is shifting to be more and more electronic. So right now, for investment grade US corporates, it's about 50% electronic, with high yield it's about 30, but the trajectory is towards more and more electronic trading. That, as I mentioned before, is not scalable without automation. And building tools to automate trading and other aspects of portfolio management is hard. There aren't many people who've had firsthand experience in building these tools in a kind of a robust, efficient manner. So for example, my counterparts who work on execution algos for equities or futures or spot FX, the problems that they're tackling are very, very different in nature from what is required in our algos. So it's very difficult for an existing execution algo provider in equities to say, hey, guess what? We're going to extend to credit. It's very, very different. And, the flip side of that is it's very hard for us to extend to a limit order book type market as well. We just don't have the expertise to do that. But in this very specific area of RFQ dominated, no market price feed type market, I think we have assembled the best team and we have the deepest experience. So taking that with the opportunity that's presented by this transition of a rather large market towards more electronic and automated trading was difficult to pass up. So that's why around 20 or 21, I and my co-founder, Michael Wong, left SquarePoint and started Tradewell.
Awesome. Can you explain what Tradewell is in layman's terms so that anyone could understand kind of what you guys are doing and what problem you're solving out there?
Yeah, of course. So as I mentioned, the US corporate bond market is increasingly electronic. The way it trades is through a protocol called request for quote, which is a multi-step process that originally envisioned basically two people communicate over an electronic network. As the market volume grows, both in terms of notional as well as number of trades, doing these trades manually becomes impossible. So you want to automate this RFQ trading in some fashion. The flip side to that is that in the past, investors tended to send RFQs when they wanted to trade, and dealers would respond to them. So what that means is that investors would take liquidity and pay the bid-ask spread. If they wanted to buy something, they would send an RFQ saying, hey, I want to buy this bond. And the dealers would respond saying, hey, I'm going to sell you this bond at the ask. So they would have to cross the bid-ask spread. By responding to RFQs, which is now possible on most of the major trading venues, investors can execute passively. So they can buy at or close to the bid, and they can sell at or close to the ask. So basically, our technology creates 2 points of value. One is time saving, so that the trader no longer has to manually monitor multiple trading UIs across the several venues that are active. And number 2 is passive execution. So instead of always taking liquidity and crossing the bid-ask spread, now institutional investors have the option to shift some of their trading needs to passive or more patient execution and not cross as much of the bid-ask spread.
Awesome. Thank you for that. As you're building Tradewell, what are some of the biggest surprises or challenges that you've faced thus far?
Oh my God, that's a huge list. As you know, building a business is very difficult. This is my first time around. And I would say at very high level, the biggest challenge is not knowing what you don't know. And then over time, you realize, hey, everyone around me knows I should be doing X, Y, and Z. I had no idea this was even an issue, right? But then eventually you start to realize that there's a lot out there that I might not know. And then you start trying to get mentors or try to talk to people who are running companies a couple of years ahead of you and really try to see, okay, am I missing something? Are there some unexploded landmines that I just don't even know exist? So that's kind of the overall lesson. Another lesson that I learned, and curious to see if you agree with this, is that the venture capital community thinks in terms of, I guess, buckets or types of companies. And some are viewed as good or promising, and some are viewed as less so, right? And so if you're starting a company that you want to get funded by VCs, you have to think really hard which of those buckets you fit in, and then also present yourself in a way that is understandable to VCs and that allows them to kind of be like, okay, this is an enterprise SaaS company, and so this is the path that they should be following. And I think people who, like me, who've gotten there education about running a technology startup from the show Silicon Valley, that's very surprising, right? But then if you think about it, it makes sense. Like, of course, that's how the VC industry would have evolved. So that would be another lesson that I've learned.
Amazing. Yeah, I totally agree with you on that. By the way, it's been interesting to transition from finance into the kind of more entrepreneurship, selling a product, raising money from traditional VCs, that kind of space, and then learning about what their expectations are and what that's like. Yeah, it's definitely a different world altogether. As a final question, what advice would you have? And maybe this is two questions, but advice for both aspiring quants, but then also advice for aspiring entrepreneurs.
Yeah, so this is very different. So for aspiring quants, it's a little bit easier. I think, well, easier and maybe not so easy. I think, as everyone knows, the whole area of data analysis is going through a really big change brought upon by the changes in our toolkit, right? So there's all these amazing AI models, and they're coming online and keep getting developed. And, things like LLMs, maybe they're not really great for, like, say, time series, but maybe there's some lessons in them that we can use. So I think if I was a quant starting out, the more of a toolkit I had for trying to kind of figure out which parts of the frontier in AI can be used for financial data, that's what I would focus on. And that's a very open-ended question and might be kind of hard for someone just starting out, but I think that's the area where there's going to be the biggest payoff, at least in our space. For budding entrepreneurs, I would say before doing anything, try as much as you can to spend some time with founders who are a year out, 2 years out, 5 years out, and really understand what their journeys have been like. Because being a founder, being an entrepreneur is great. It's like the most rewarding thing ever, but it's definitely not for everyone. And I think, this is what I tell job candidates that we interview is working at a startup is very different than working in a large company. And being a co-founder and CEO of a startup is also very different. So the more information you can get about what that means for your life and like the kind of not just the risk reward, but like every day, what do you expect will happen every day? Just basic questions like that. The more you can answer them for yourself before taking the plunge, I think the more success you're likely to have.
Thank you so much, Alex, for taking the time and giving us so much advice and sharing your journey with us today. I hope that everyone enjoyed this episode, and you can keep in touch with Alex, I'm sure, on LinkedIn and wherever else he can be found. So take care and enjoy the rest of your day.
Yeah, thanks, Christina. Bye.